The global economy is navigating a period of significant turbulence. As we look at the 2025 to 2026 horizon, the world is grappling with subdued growth, heightened trade tensions, and persistent policy uncertainty. Projections show global economic growth slowing, a stark contrast to pre-pandemic averages. This challenging environment sets the stage for a complex interplay between three critical economic forces: inflation, interest rates, and the value of the dollar. Inflationary pressures are expected to persist. While some relief may come from lower energy prices and a slowdown in shelter inflation, the overall temperature remains high. Tariffs, a weakening dollar, and a tight labor supply are all contributing factors. We anticipate year-over-year CPI inflation to climb to around 3.5% by the end of 2025, before gradually easing to 2.8% by late 2026. This is still well above the Federal Reserve's 2% target, signaling that the fight against rising prices is far from over. Some experts even predict that global inflation will remain elevated for the next several years, with regional variations creating a complex global picture. In response to this stubborn inflation, all eyes are on the central banks. The Federal Reserve faces a delicate balancing act. While the primary goal is to curb inflation, they must also avoid stifling economic growth. There are conflicting signals on the direction of interest rates. Some analysts expect the Fed to ease rates more than anticipated in 2026, especially if a disinflationary trend takes hold in the second half of the year. However, others argue that, with inflation remaining stubbornly above target, significant interest rate cuts are unlikely. This uncertainty around monetary policy will be a major driver of market volatility in the coming years. This brings us to the US dollar. The combination of persistent inflation and potential shifts in monetary policy is expected to put downward pressure on the dollar. A weakening dollar is a double-edged sword. On one hand, it can boost exports and make US goods more competitive. On the other, it contributes to inflationary pressures by making imports more expensive. As we move through 2025 and into 2026, we can expect to see the dollar continue its depreciation, a trend that will have far-reaching implications for international trade and investment. So, what are the key lessons from this period? First, the era of low inflation and stable growth appears to be behind us. Businesses and individuals need to prepare for a more volatile economic environment. Second, the actions of central banks will be more critical than ever. Their ability to navigate the fine line between controlling inflation and supporting growth will determine the economic trajectory for years to come. Finally, the interconnectedness of the global economy means that these trends will not be confined to one country. The dollar spiral, driven by domestic inflation and interest rate policies, will have ripple effects across the globe. Understanding these dynamics is crucial for anyone looking to navigate the economic landscape of 2025 and 2026.